The USDA loan program is the best loan program for non-veterans that are considering buying a home. But here's the catch. You have to meet the income and employment guidelines in order to qualify. And that's exactly what we're going to dive into in today's video. The USDA loan is a loan that allows you to buy a home with literally no money down, with credit scores as low as 580. But here's the catch. You have to live in a rural area in order to qualify. So if you're watching this video going, Jeb, what is a rural area? How do I know if my area actually qualifies? Well, I've put a link in the description below from the USDA's website where you can go and check the area that you're looking to purchase to see if you can actually buy a home using a USDA loan. But more importantly, this video is to talk about income and employment when it comes to USDA, because there's often a lot of confusion around those two topics. And that's exactly what we're going to dive into right after you hit that thumbs up if you find any value in my videos at all. And while you're hitting that thumbs up, do me a favor and subscribe to the channel to stay updated on everything mortgage and real estate related. Now, one thing I like to mention early on in videos like this is that USDA loans are not just for first-time home buyers. Yes, they allow lower credit scores. Yes, they allow little to no money down. And people often get confused when they hear that and say, well, that's just for a first-time home buyer. And that's simply not the case. USDA loans can be used multiple times to buy multiple pieces of property, but you have to meet the guidelines in order to do it. And one of those guidelines is income when it comes to buying a home using a USDA loan. Now, out of all the loan programs out there, FHA, VA, and conventional loans, none of them actually have any restrictions on how much income you can make. In fact, with all of them, there's no limit at all. You can make as much money as you want. You can make $1 million per year and use any of those loan programs. But that's one of the biggest differences when it comes to USDA. Whereas USDA actually sets income limits to ensure that loans are actually available to those that need them. And these limits are based off the median income from the area in which you're looking to purchase. But one of the nice things about USDA is that they adjust for family size. So if you're a single individual, you're going to have a maximum income set on one person. Whereas when you move to 2, the income is going to go up, 3, 4, 5, so on and so forth. But this is really where a lot of people get it confused. When they hear household income, they think it's just between the husband and the spouse, or the wife and the spouse, whoever it is that's going together on the loan to buy the home. When in fact, it should be household income. Every single person in the house that's currently working, you're tallying up that income to see if you're under that median income limit. And generally speaking, the household income shouldn't exceed 115% of the area median income. Now, earlier in the video, I mentioned there was a link in the description below to check to see if the area that you're looking is actually rural. Well, that same link can tell you what the median income is for the area that you're looking to purchase, so that when you're tallying up your total income, you know whether or not you're below or above that threshold. Now, before you go do that, you start tallying up your income to try to figure out whether or not you qualify. I always like to mention that this video is for novelty purposes only. I'm here to provide education, to provide guidance, to let you know the basics of loan requirements when it comes to programs like USDA. But what a lot of people do is they take my information, they run off, and they start doing these calculations on their own, and they say, yeah, I qualify, or no, I don't, based off what you just said. Instead of doing that, you should actually talk to a mortgage professional that does this every single day. Let them look at your income documentation. Let them look at your credit scores and determine whether or not you qualify based off the information you provided. Now, if you're watching this and you don't know where to start, well, I actually put a link in the description below where you can work with my team, my personal team who does mortgages all across the United States, where we can not only answer that question for you for free, we can also help guide you to the finish line. So if you're in the process of searching around, you're looking for another opinion, do me a favor and check that link below. Now, a moment ago, I mentioned debt to income as being one of the requirements that they're going to look at when they're checking your income. Now, a lot of people don't really understand debt to income, but I want to touch on it briefly before we start talking about the employment side of what USDA requires in order to be approved for their loan. So when it comes to buying a home, the way the lender determines how much home you can afford is they take your gross monthly income and they divide it by how much debt you have, hence the name debt to income ratio. And when it comes to USDA loans, they have a requirement of 41 or 42% or so on the back end ratio. You can't have more monthly debt, which we'll explain here in just a minute, than 42% of your take-home income. But with nearly 20 years in the mortgage and real estate business, I've seen several occasions where people have gotten qualified with 45, 46% or so when it comes to debt to income ratio on a USDA loan. But in order to calculate this, what you do is you take your gross monthly income. You want to start there. So for purposes of this video, let's just say you make $120,000 per year. Well, we divide that by 12 because there's 12 months. That breaks down to $10,000 in gross monthly income per month. Now, that's before any taxes are taken out. We're not actually worried about taxes. We're not worried about how much you pay into your 401k, how much you put in your deferred comp. None of that matters because the lender isn't actually using that amount to qualify you. They're using the gross amount. Now, a lot of people watch this and go, well, Jeb, I'm paying taxes, I'm paying all of this stuff, I'm not bringing home the amount you're using. Why are you using that? Well, it's because everybody takes home a different amount because of exemptions and how they pay into different things. And in order to keep it fair and easy to calculate, the lenders use gross monthly income. Now, if you're self-employed, this can be more difficult to calculate because you have expenses in your business that you can write off and there are different things you do. So what you're actually taking home could be more or less on what you're reporting on your yearly taxes. And that's all the more reason to make sure you're having that conversation with a professional and not trying to do this on your own, because you don't want to mess up and think that you did something right and then go out shopping for a home, go under contract and realize, no, you got it wrong because you didn't take the proper steps to begin with. So instead of trying to do these steps, make sure you're talking to a professional, which there's a link in the description below, that can guide you through that process. So now that we have your gross monthly income calculated, in order to get the debt side, what we're doing is we're taking the debts from your credit report. Those are things like your car payments, your credit cards, student loans, any sort of revolving or installment debt. Things that you had to apply for in order to get credit are typically the things that are showing up on your credit report. What's not showing up is how much you spent in groceries this week, or how much you spent going to the movies, or out on date night, or how much you spent on that trip to Hawaii. None of that matters when it comes to the lender's qualifications. And that's why it's really, really important that as a potential buyer out there, you're creating a budget prior to having that conversation with the lender so that you truly know how much home you can afford and you're not relying on a lender to tell you how much you can afford. Now, I realize I just threw a lot of information at you when it comes to income, but that's essentially what the lender is looking at in order to determine how much home you can afford. So they're looking at that gross monthly income. Do you meet that threshold that USDA has? And out of that income, how much of your debt is actually being used towards your housing expenses as well as all of your monthly debts, because it's a total ratio of those numbers. There's a front end ratio and a back end ratio. The front end ratio is just your housing expenses. That's your mortgage payment with the principal and interest. It's your property taxes. It's your homeowner's insurance. If there's an HOA, that's in there. If there's mortgage insurance, that's part of it as well. So it's that total payment of your housing expenses. That's the front end ratio, plus whatever comes up on the back end ratio. So for purposes of this video, let's just say you have a $3,000 house payment with everything included. Property taxes, insurance, mortgage insurance, everything gets $3,000 a month. And let's say that you have $500 in monthly debt that shows up on your credit report. Well, that's a $3,500 total payment. So that's your front end, your housing expenses, plus what shows up on the back end ratio, which is your housing expenses plus that 500. So you know your front end ratio in this case is 3,000 divided by 10,000. So your front end ratio is 30%, and your back end ratio is the combination of your housing expenses plus that debt. So 3,500. So in this case, we divide 3,500 into 10,000. So we know your back end ratio is 0.35 or 35%. So you should meet the income restrictions for USDA, assuming you meet everything else. Now, I realize I just did a lot of complex calculations, and that's why I'm telling you, use this for novelty purposes and don't try to do it on your own. Now, the next thing I want to talk about is employment. Now, this is where a lot of people have a lot of questions, because the guideline reads that you should have 2 years of steady income and steady employment. And when I say that, a lot of people are led to believe that they have to be in the same line of work or at the same job for 2 years, making the exact same income. Otherwise, they're not going to qualify. And that's simply not the case. The lender just wants to verify that you have stable employment, that you've essentially been employed for the better part of 2 years. Now, when I say the better part of 2 years, there could be some small gaps of employment. Maybe you got sick, you couldn't work, maybe you were laid off from your job, and in the meantime, you were trying to find another job. All of those things are reasonable and could happen, and assuming you have an explanation for it and can show documentation, the lender's probably likely to work with you in those cases, as long as you don't have these huge gaps. Now, out of 2 years, if you've been unemployed for a year and a half, and you're trying to meet that guideline, it's probably going to be tough because the lender essentially wants to see some consistency with that employment. Now, at the same time, you don't have to be on the same job. You just really want to be in the same line of work, doing the same type of thing, if you will. And you don't really want to go from a wage earner to a self-employed borrower, because that is very, very difficult to make that transition and to make the numbers work. And most of the time, that's going to be a huge sticking point. But on the other side, if you went from self-employed to a wage earner, that could work in some cases. But again, you need to be in the same line of work. You don't want to be going from being a personal trainer to working in the mortgage industry, right? We see a lot of that sort of thing. That's completely different type of income. Now, if you were in sales at one job and now you're in sales in a completely different job, or you were in the restaurant business, say you were a hostess and now you're a server, all of that stuff typically works when it comes to satisfying the employment part of the guidelines for USDA loans. Now with that, there's always extenuating circumstances where maybe you were in college and you weren't working, and then you graduated and came out of college and now you have a job. Well, lenders can actually use your schooling in some cases to make up for that portion of employment that you don't have. But when it comes to that sort of thing, it's often a case-by-case basis and needs to be worked over with an underwriter. Your lender probably needs to run it by the lender to actually see if that's going to pass. And that's one of the reasons that it's important to get pre-approved early on, so that you're not surprised if you're now ready to go buy a home and you're having this conversation going, well, I had no idea. If I knew that was the case, I wouldn't be here now. Well, the earlier you go through that pre-approval process, the better off you're going to be, because it gives you time to work on things if you need to work on them. But more importantly, it confirms whether or not you're in a position to actually move forward in buying a home. So the sooner you can do it, the better off you're actually going to be. Now, if you're watching this video going, Jeb, I meet the income requirements, I meet the employment requirements when it comes to USDA, what other requirements are there? Because I'm really interested in using this loan. Well, do me a favor and check out this video here.